Welcome back to the Deep Dive, everybody. Today, we are bringing our Talk Tickers format to the table for a really special feature-length breakdown.
Yeah, we're getting into the weeds on this one. I'm excited.
Oh, absolutely. So our mission today is to break down the Q2 2026 earnings transcript for Ecolab, ticker symbol ECL, and, translate all that dense Wall Street jargon into plain English for you.
Right, because we want to figure out the actual mechanisms driving their results.
Exactly. Pull out the hard data, see what's moving the needle, and give you an actionable take on whether this stock is a bullish or bearish play for your portfolio right now.
Which is funny, because usually when you look at an industrial cleaning stock, you expect something, slow.
Yeah, plodding, safely confined to a low-margin grind.
Totally. You picture giant vats of industrial bleach, maybe some bulk floor wax.
Right, guys in hard hats hosing down factory floors.
Yeah.
And you assume that is literally the entire business model.
Yeah, you expect single-digit growth, a predictable dividend, and just very little drama.
Exactly. And for decades, that slow, steady predictability was exactly what drew a certain type of retail investor to that corner of the market.
Oh, for sure. It was the ballast in a portfolio. You didn't buy it for explosive growth.
You bought it because industrial floors always need to be clean no matter what the broader economy is doing.
Right. It's defensive.
Yeah.
But if you look at this Q2 2026 earnings call for Ecolab, that traditional, boring industrial stereotype just completely falls apart.
It shatters. Instead of mops and buckets, this transcript reveals a company completely dominated by artificial intelligence infrastructure.
Yeah. AI infrastructure, biopharma manufacturing, connected digital networks, all of it operating right behind the facade of a traditional chemical and water company.
It's honestly a fascinating structural pivot. You have this massive legacy enterprise that has quietly repositioned itself at the absolute center of the two most capital-intensive growth trends of this decade.
Right. AI computing and advanced healthcare.
Yeah.
It's wild.
So we need to start with the headline numbers, because the raw data dictates the reality of the business. And the metrics coming out of this specific quarter tell a very specific story about how effectively they're managing this pivot.
Yeah, let's lay those numbers out. The top and bottom lines are pretty striking.
So getting right into it, their adjusted earnings per share, the EPS, grew by a massive 11%.
11% in this economy.
Right. And organic sales growth was up 5%. But then there is this secondary metric they reported, which is pro forma sales growth, which includes their recent acquisitions.
And that would have been 7%.
Exactly, 7%. Plus, their pricing power strengthened to 4% in the quarter.
I want to pause on that distinction between organic and pro forma growth, just really quick. Because if you're evaluating a company heavily involved in acquisitions, you have to understand exactly what those two numbers represent.
Yeah, break that down for us. What's the difference?
So organic growth is the true baseline health of the business. It measures how much more revenue they generated from the exact same assets they owned 1 year ago.
Meaning no new toys included in the math.
Right. So that 5% organic growth means they are successfully selling more volume or, charging higher prices to their existing customer base with their legacy products.
So they aren't just buying their way to growth. The underlying engine is actually accelerating on its own.
Exactly. But the pro forma number, that 7%, is arguably just as critical for forecasting the future for you as an investor.
Because it bakes in the new acquisitions.
Right. Pro forma essentially asks the question, what would our growth rate have looked like if we had already owned our newest acquisitions for the entire past year?
Got it. So it gives you a smoothed out look at the new combined entity's momentum.
Exactly. And in Ecolab's case, because they are buying highly specialized high growth assets, like we'll see with their data center cooling tech, the pro forma growth naturally outpaces the organic growth.
They're strapping faster engines onto the existing ship.
That's a perfect way to put it, yeah.
Which brings us to the volume metric. The transcript shows volume grew by just 1%.
Yeah, that one stands out.
I have to admit, looking at an 11% EPS jump, but only a 1% volume increase, it feels a bit disconnected.
It does. 1% sounds practically stagnant.
Right. Especially for a company pushing into all these high-growth tech sectors. How are they driving double-digit earnings growth if the actual physical volume of products they are moving is barely ticking upward?
It's a critical discrepancy to investigate.
Yeah.
But the CEO, Christophe Beck, actually addressed this directly on the call.
Oh, he did?
Yeah. He noted that the 1% volume growth is actually masking the true underlying demand due to geopolitical factors.
Like what kind of factors?
He said the volume number would have been 2%. It's not for a 1% direct headwind caused by ongoing supply chain and operational disruptions in the Middle East.
Oh, wow. So an entire percentage point was just wiped out by regional conflicts.
Exactly. So when you strip out that regional and hopefully temporary geopolitical shock, the core volume demand is healthier than the headline suggests.
Okay, so a 2% normalized volume makes a bit more sense, but I mean, it still doesn't fully explain an 11% earnings beat.
No, it doesn't.
The real story seems to be hiding in the segment breakdowns, right? The growth rates in their specialized divisions are completely detached from that company-wide average.
Yeah, the segment numbers are where things get crazy.
Let's rattle these off. Life Sciences was up 15%, Ecolab Digital was up 27%, Pest Elimination grew 7%, and Global High Tech posted an astonishing 29% growth.
I mean, those are numbers you expect to see on a software as a service earnings call.
Not a legacy industrial materials call.
Definitely not.
And that leads to a really fundamental question about the macro environment. We're in the middle of 2026. The earnings call specifically noted that U.S. restaurant foot traffic is down 5% year over year.
Yep. The consumer is pulling back.
Commodity costs are remaining stubbornly high. Traditional manufacturing is sluggish. So how does a company heavily exposed to institutional dining and industrial cleaning post an 11% bottom line beat and 29% tech growth when its foundational customers are seeing declining foot traffic?
That's a fair question.
Yeah.
But the math works because of how management has actively layered the portfolio.
Layered it how?
They've essentially categorized the business into three distinct tiers. First, you have what they openly refer to as underperforming or legacy sectors.
Like what?
The paper and pulp division is a perfect example. It's a slow, cyclical, highly consolidated industry that drags on the overall corporate average.
So it might shrink by 1% or grow by 1%, but it's never going to be a rocket ship.
Exactly. Never going to be a rocket. Then you have the middle tier.
The core businesses.
Right. Food and beverage safety, institutional hospitality cleaning, basic water treatment. These are the defensive, recession-resistant cash generators.
Because even if restaurant foot traffic is down 5%, a commercial kitchen still has to run its dishwashers.
Yes, they have to sanitize their prep stations and treat their wastewater to comply with local health codes, regardless of how many burgers they sold that day.
So that core business remains incredibly sticky.
Incredibly sticky, and it continues to churn out steady, mid-single-digit growth, providing just a massive baseline of free cash flow.
Which sets the stage for the third tier.
The growth engines.
Yeah.
Global high tech, life sciences, and digital.
And because these specific divisions operate at significantly higher profit margins than selling, bulk sanitizer.
A way higher margin.
And because they are compounding at 15 to 30% annually, they are becoming a progressively larger slice of the total Ecolab pie.
Exactly. Every single quarter, the high margin tech side represents a larger percentage of the total revenue than it did the quarter before.
It's just a mathematical mix shift. Even if the legacy paper business and the institutional restaurant business are just treading water, the sheer velocity of the high-tech division pulls the consolidated company averages upward.
That is exactly how you get 11% earnings growth out of 1% volume growth. The mix of what they are selling is shifting heavily toward premium, highly engineered solutions.
Okay, that makes sense. But mix shift alone doesn't entirely cover it. There is an immediate operational catalyst for this massive EPS beat, and it centers on how they handled inflation.
Yeah, this is where the transcript gets genuinely impressive from an execution standpoint.
Totally. Ecolab entered Q2 facing a steep rise in the commodity costs required to manufacture their foundational chemicals.
And historically, in the chemical and industrial sectors, when your raw material costs spike, you are faced with a brutal binary choice.
You either eat the higher costs,
which instantly compresses your profit margins and punishes your stock price. Yeah.
Or you attempt to force those costs onto your customers through price hikes,
which risks losing market share to cheaper competitors. It's a tough spot.
But Ecolab took the second path, and they executed it with surprising aggression. They didn't just implement standard structural pricing adjustments, they rolled out a global energy surcharge across their entire customer base.
Yeah, and by the end of the quarter, They had achieved 5% overall pricing power.
Which is huge. To understand why the analyst community reacted so positive to that specific metric, you really have to look at the historical context.
Christophe Beck highlighted a concept he called value pricing on the call.
Yeah, what does that actually mean in practice?
Well, in previous economic cycles, say, a decade ago, when Ecolab faced a sudden inflationary spike in raw materials, it typically took the company 2 full years of gradual price increases to fully recover those incremental costs.
2 years?
Yeah, 24 months just to rebuild their historical profit margins. It was a slow, painful cycle of playing catch-up.
And in this quarter, in 2026, they completely closed that gap and recovered the margins in 3 months.
90 days. They condensed a 2-year recovery cycle into a single quarter.
See, here is where I have a hard time squaring the logic from a consumer perspective.
How so?
If a streaming service raises its monthly subscription fee by 5% in a single quarter, a massive chunk of the subscriber base immediately cancels.
Sure, they churn out.
Right. So if an industrial client is already facing a tough macro environment, their own costs are up, maybe their sales are slowing, why on earth would a factory manager accept a 5% surcharge from their water treatment provider?
They'd be furious, you'd think.
Exactly. Why wouldn't they just call up a generic chemical supplier and switch to a cheaper bulk bleach?
It is the logical question, but it requires shifting your framework from consumer psychology to B2B industrial economics.
Okay, shift me.
You're thinking of Ecolab as a vendor selling a commodity like a bucket of soap. If they were just selling soap, the factory manager would absolutely switch. But Ecolab's entire modern business model is predicated on selling operational efficiency.
Walk me through the mechanics of that. How does operational efficiency stop a customer from canceling over a 5% price hike?
Think of a massive commercial laundry facility or a food processing plant. Water and energy are 2 of their absolute highest variable operating costs.
Right, boiling water takes a ton of power.
Exactly. Heating thousands of gallons of water to industrial sanitization temperatures requires massive amounts of natural gas or electricity. Ecolab doesn't just drop off chemicals.
What do?
They install automated dosing systems and proprietary chemistry that allows that food processing plant to clean its equipment at significantly lower temperatures using drastically less water in a shorter amount of time.
Oh, wow. So they are altering the physical operating parameters of the factory itself.
Yes, and they measure it obsessively. So when the Ecolab rep goes to the factory manager to explain the 5% global energy surcharge, they aren't just handing over a higher bill.
They're bringing the receipts.
Literally. They bring a dashboard that says, yes, our service will cost you an additional $10,000 this quarter. However, the proprietary low-temperature chemistry we installed last month has reduced your factory's boiler energy consumption by 15%.
And your municipal water intake by 10%.
Exactly. So we have mathematically saved you $30,000 in local utility bills.
So the cost of the surcharge is entirely eclipsed by the hard dollar savings generated by the technology.
Exactly. It operates almost like a toll road that pays you to drive on it. The customer accepts the 5% hike because the Ecolab solution fundamentally improves the unit economics of their own factory.
That's brilliant. And Christophe Beck noted on the call that despite rolling out this aggressive pricing action, their customer retention rate remained incredibly stable across the board.
Because it has to. That is the definition of a structural economic moat.
A customer cannot afford to fire you because removing your system will trigger an immediate spike in their own water and energy costs.
Right? A spike that vastly outweighs whatever they might save by switching to a cheaper chemical provider.
It proves that their value proposition is mathematically undeniable to the end user.
And it's this exact dynamic, customers willing to pay a premium for systems that guarantee operational uptime and resource efficiency, that perfectly sets up the most explosive revelation in the entire transcript.
You are talking about the transition into global high tech.
The AI and data center boom.
Oh man, this part is wild.
Because if a food processing plant is willing to pay top dollar to save 15% on its boiler energy, you have to imagine the pricing power Ecolab has when the actual physical survival of a multi-billion-dollar artificial intelligence data center depends on their technology.
The numbers in this segment are genuinely staggering. Management seamlessly transitioned from discussing pricing power into detailing the sheer scale of the global high-tech division.
It is now their largest growth engine by a wide margin.
Yeah, they are currently approaching $1.5 billion in annualized sales in this unit alone.
Which is insane.
To put that trajectory in perspective for you, just 5 years ago in 2021, this division was generating roughly $150 million.
They have scaled this specific business by a factor of 10 in half a decade.
A 10x scale up. And the primary fuel for this acceleration isn't just organic cross-selling, right? It's a highly targeted acquisition strategy.
Right. They have bought their way into the absolute center of the data center supply chain through companies like Avivo and, crucially, their recent acquisition of Coolighter.
Coolighter is a beast. The transcript notes that Coolighter was growing at over 100% year to date, even before Ecolab officially closed the deal.
Over 100%.
Yeah.
And everyone in the market right now is obsessively focused on the microchip.
Yeah, you look at NVIDIA, you look at the large language models, the generative AI software.
But a microchip is a physical object. The reality of training a massive AI model is that you're running tens of thousands of these hyperdense processors at maximum capacity 24 hours a day.
And they require unimaginable amounts of electricity.
Huge amounts. And the byproduct of that electricity is extreme concentrated heat. If that heat isn't removed instantly, the silicon literally melts.
Thermodynamics is the fundamental physical bottleneck of the entire artificial intelligence revolution.
It really is. You can design the smartest algorithm in the world, but if you cannot cool the physical rack it runs on, the technology stops.
And the way we have historically cooled data centers is colliding violently with environmental reality.
Let's break down that collision, because this is where Ecolab's specific technology becomes so critical.
Right. How were these data centers being cooled before, and why is it failing now?
So for decades, standard cloud computing data centers relied primarily on traditional HVAC systems and massive evaporative cooling towers.
Just blowing cold air.
Exactly. You push cold air through the server racks, the air absorbs the heat, and you use enormous rooftop cooling towers to dissipate that heat into the atmosphere.
But the problem with evaporative cooling is right in the name, isn't it? Evaporation.
Exactly. To remove that much heat, these facilities consume millions of gallons of fresh municipal water every single day. The hot water evaporates away, and they have to constantly pull fresh, clean water from the local reservoir to replace it.
Which, that was manageable when data centers were just hosting websites and email servers. But an AI training cluster runs significantly hotter.
Exponentially hotter. We are talking about rack densities going from 5 or 10 kilowatts of heat per rack up to 100 or 150 kilowatts per rack.
Wow.
And air is fundamentally a terrible conductor of heat. You literally cannot push cold air fast enough through these new AI server racks to keep them from overheating. Air cooling has hit the limits of physics.
So data center operators have to use more intensive liquid cooling, which historically meant consuming even more local water.
And this is where the political reality hits. You cannot walk into a municipality in Nevada or Arizona or even parts of Virginia and tell the local government that you want to build a new AI facility that will drain millions of gallons from their drinking water supply so a tech company can train a chatbot.
People would riot.
Exactly. Communities are actively pushing back. Local governments are denying zoning permits. The lack of available water and power is stopping multi-billion-dollar construction projects in their tracks.
This is the exact crisis that Ecolab's global high-tech division is built to solve. They bring an integrated platform that addresses both the physical thermodynamic problem and the political municipal problem simultaneously.
Yeah, and they do this by combining Coolighter's direct-to-chip liquid cooling hardware with Ecolab's proprietary 3D TraceR digital monitoring technology.
I want to understand the mechanics of this integration. How does direct-to-chip cooling actually change the equation compared to the old evaporative towers?
Well, instead of trying to blow cold air across a room, Coolighter manufactures microchannel cold plates. These are highly engineered pieces of metal that are physically mounted directly on top of the actual AI silicon processor inside the server.
Right on the chip itself.
Right on the chip. A specialized dielectric liquid coolant is pumped through microscopic channels inside this plate. Because liquid is orders of magnitude more efficient at absorbing heat than air, it pulls the extreme thermal load directly off the chip instantly.
And then what happens to the hot liquid?
That hot liquid is then pumped away to a heat exchanger, cooled down, and pumped right back in a continuous closed loop.
Okay, the key phrase there is closed loop. Because it is a closed loop, you aren't evaporating the water into the atmosphere.
Exactly. And this leads to the most critical phrase uttered on the entire earnings call. Management stated that they can cool these hyperdense AI chips using less total power and with zero net incremental water.
Zero net incremental water. That changes the entire permitting conversation for a tech giant trying to build a facility.
It is the ultimate key to unlocking zoning approvals. An Amazon or a Microsoft can go to a local city council and prove that their new massive AI data center will not draw continuous millions of gallons from the local reservoir.
But the hardware alone isn't enough.
No, because water, even in a closed loop, is highly corrosive. If you run liquid through metal pipes and heat exchangers 24/7, you inevitably get microscopic scale buildup, corrosion, and biological fouling.
Which acts as an insulator. If scale builds up inside the cooling pipes, the heat can't transfer out of the liquid, the cooling efficiency drops, and the servers overheat anyway.
This is where Ecolab's 3D TRASAR technology comes in.
Oh, okay. What is 3D TRASAR?
3D TRASAR is a network of digital sensors and controllers installed directly into the cooling system's pipelines. It doesn't just passively monitor flow. It uses advanced fluorescence technology to analyze the chemical composition of the water at the molecular level in real time.
Real-time molecular analysis inside the cooling pipes.
Exactly. If the sensors detect that a specific anti-corrosive polymer is being depleted, or that the pH balance is shifting toward a state that might cause scaling, the system automatically injects the precise microdose of specialized chemistry required to correct the imbalance before a single millimeter of scale can form.
That is wild. So they are marrying the physical cooling hardware of Coolighter with the predictive, automated chemical management of 3D TRASAR, guaranteeing that these closed-loop systems operate at peak thermal efficiency for years without degrading.
And the demand for this specific integrated solution is bordering on unprecedented for an industrial supplier.
There was a moment during the Q&A portion of the transcript that really illuminated the market dynamics here.
Yeah, an analyst specifically asked Christophe Beck about the customer reaction to Coolighter's new 50-kilowatt cold plate,
which is their newest, highest capacity direct-to-chip hardware designed for the absolute bleeding edge of AI processors.
Right, and the CEO's response was fascinating. He didn't just give a standard corporate demand is strong answer.
No, he sounded genuinely astonished by the market behavior.
He stated it was the first time in his entire business career that he has witnessed B2B industrial customers not just wanting to place an order and get in the queue, but actively attempting to jump the queue to secure hardware ahead of their competitors.
Jumping the line for industrial cooling plates?
When you have hyperscale technology companies fighting for allocation and trying to cut in line like teenagers for a concert ticket, you are looking at a market where demand is violently outstripping supply.
Ecolab's primary constraint right now isn't sales or marketing. It's physically manufacturing these highly engineered cold plates fast enough to satisfy the architectural build-out of the AI revolution.
This intense demand naturally leads to how management is forecasting the future of this division. They are hosting a highly anticipated investor day at the Supercompute Conference in Chicago this coming November.
And on this Q2 call, they officially laid out a long-term target for the global high-tech division. $4 billion in total sales, operating at a 25% margin by the year 2030.
But if you read the subtle exchanges during the Q&A, several analysts actively tried to corner management into raising that specific target even higher.
I noticed that too. The logic is sound, right? If Coolighter is already growing at 100% year over year, and the structural bottleneck of AI data centers is only getting more severe, $4 billion seems artificially low.
Yeah, management played it somewhat coy. They maintained the $4 billion figure for now, stating they wanted a few more months to fully integrate the newly acquired teams and analyze the combined run rates before officially updating their long-term financial models.
But they heavily hinted that the $4 billion target might, in fact, prove to be highly conservative.
When they take the stage at Supercompute in November, with the full engineering integration complete, I would strongly expect to see their calculation of the total addressable market and their internal revenue targets revised significantly upward.
So for anyone actively monitoring this stock, that November Supercompute presentation is a massive, concrete catalyst date to circle on your calendar.
Absolutely.
But while the AI cooling narrative is undeniably the most aggressive growth lever, it isn't the only secular trend they are riding. We need to look at the other major pillar driving their high-margin expansion, which is detailed in their life sciences segment.
The biopharma boom is the quiet giant in this earnings report. Life sciences accelerated to 15% organic growth in the quarter.
And reading through the transcript, what stands out is exactly where they are capturing this growth. They are aggressively taking market share in the bioprocessing space, specifically in the manufacturing of resins.
Right, as pharmaceutical companies move complex biologics and cell therapies out of early-stage clinical trials and into full-scale global commercial manufacturing.
To appreciate the barrier to entry here, you really have to understand the mechanics of biomanufacturing.
Yeah, because when a pharmaceutical company produces a complex biologic drug, like a monoclonal antibody for cancer treatment, they don't just mix chemicals in a vat.
No, it's way more complicated.
They genetically engineer living cells, usually mammalian cells, to secrete the desired therapeutic protein inside massive bioreactors.
But the output of that bioreactor isn't just the pure drug. It is a biological soup containing the target protein along with cellular debris, host cell proteins, DNA fragments, and metabolic waste.
Exactly. You have to isolate the specific life-saving molecule from that complex mixture with absolute zero-tolerance precision. This is known as downstream processing, and it relies heavily on chromatography resins.
Chromatography resins. Okay, break that down.
These resins are essentially microscopic, highly engineered beads packed into large columns. As the biological soup flows through the column, the specific chemistry on the surface of the resin beads is designed to bind exclusively to the target drug molecule, letting all the impurities wash away.
And then you alter the chemical environment in the column to release the pure drug.
Right. It is a microscopic filtering technology operating at an incredibly high value. The transcript indicates these specialty resins can cost thousands of dollars for a single liter.
Wow, thousands of dollars for 1 liter of beads.
They command extreme pricing power because the stakes are existential. The biopharma industry operates under the strictest FDA regulations on the planet. The margin for error is literally zero. If a single batch of a biologic drug is contaminated or improperly purified, it can cost the manufacturer tens of millions of dollars and physically endanger patients.
So once a pharmaceutical company successfully validates a specific Ecolab purification resin during their FDA approval process, they are structurally locked in.
Yes. Changing a critical raw material like a chromatography resin in a commercial stage drug manufacturing process requires extensive revalidation and regulatory filings with the FDA. It is incredibly expensive and time-consuming.
So pharmaceutical companies simply do not change their validated suppliers unless forced to.
Once Ecolab wins the specification for a drug entering commercial production, that revenue stream is locked in for the entire patent life cycle of that therapy.
And Ecolab heavily accelerated their entry into this space when they acquired Purolite a few years ago, right?
Right. And what we are seeing in the Q2 2026 data is the inflection point, where those multi-year investments in specialized talent and breakthrough resin innovation are finally scaling across the global biopharma pipeline.
However, there is a specific piece of margin accounting in the transcript regarding the life sciences division that definitely requires translation.
Oh, the CapEx drag.
Yeah. The financial reporting noted that the life sciences segment delivered an operating margin in the high teens for the quarter. But Christophe Beck and the CFO actively insisted that the underlying margin of the business is actually in the mid-20s.
A 600 or 700 basis point gap between what the official accounting statement says and what management claims the business is actually generating is significant.
Very significant. Why is there such a massive discrepancy?
The gap is entirely driven by proactive capital expenditures, or CapEx. Ecolab is intentionally depressing their reported near-term margins because they are deploying massive amounts of capital ahead of the projected demand curve.
Specifically, the transcript highlights that they have just opened a massive state-of-the-art bioprocessing manufacturing plant in China while simultaneously expanding their production capacity in North America and Europe.
And from an accounting perspective, when you build a giant new facility, you have to absorb the depreciation of that asset, the hiring of new specialized staff, and the operational startup costs on your income statement immediately.
Even before the factory is running at maximum efficiency.
Exactly. Those heavy upfront startup costs drag the blended reported margin of the entire division down to the high teens. But the underlying unit economics of the actual resins and contamination control products they are successfully selling day to day operate at a mid-20s margin profile.
It's a calculated short-term penalty for long-term dominance. As Christophe Beck made clear on the call, they anticipate this life sciences business will eventually run at a 30% operating margin once these new facilities reach their targeted cruising speed.
But They're willing to absorb the temporary accounting hit today to ensure they have the physical capacity available to capture the explosive market share growth tomorrow. You cannot win a multi-million-dollar commercial biopharma contract if you have to tell the client you don't actually have the factory space to manufacture their critical components.
It is the correct strategic move, but it highlights a fundamental financial reality for the entire company. Building massive biomanufacturing plants in Asia and acquiring high-growth AI cooling companies in North America requires an astonishing amount of capital.
Huge amounts of cash.
Which naturally begs the question, where is Ecolab getting all this cash? They aren't behaving like a volatile tech startup that has to constantly dilute its shareholders by issuing new stock to fund its operations.
No, they are entirely self-funding this massive technological pivot.
And that reality pivots us directly back to the legacy businesses we discussed at the beginning of the breakdown, the core reliabilities.
The steady cash generators. Let's look at how those foundational divisions performed in this quarter. The food and beverage segment grew by 7%.
And management heavily attributed this solid performance to their One Ecolab strategy, which is fundamentally an aggressive cross-selling initiative.
It is a highly efficient growth mechanism. If they already hold the contract to provide food surface sanitization for a massive dairy processing plant, the One Ecolab strategy mandates that they leverage that existing relationship to sell that same plant their wastewater treatment solutions, their boiler energy efficiency programs, and their pest elimination services.
They are increasing their total revenue and their embedded stickiness without incurring the customer acquisition costs of finding a brand new client. They are simply deepening their share of the customer's wallet.
Then you look at the institutional business, which supplies the global hospitality and restaurant sectors. It grew by 4% organically.
Now, in a vacuum, 4% doesn't sound explosive, but you have to contextualize it against the macro data point they shared. Overall, U.S. restaurant foot traffic dropped 5% year over year.
That contrast is the definition of market resilience. The broader industry they serve is actively contracting by 5%, yet Ecolab's segment serving that exact industry managed to grow by 4%. They are aggressively capturing market share.
Because whether consumers are trading down to quick-serve fast food or trading up to premium fine dining, Ecolab supplies the hygiene standards for all of them. They capture the revenue regardless of where the consumer chooses to eat.
Even the paper sector, which, as you mentioned earlier, the CEO affectionately categorizes as an underperforming legacy business, actually turned positive in Q2. The massive wave of mill consolidation that had been disrupting the paper industry finally paused, allowing Ecolab's supply volumes to stabilize and inch upward.
If you are an investor looking at portfolio construction, this dynamic explains why you might choose to own Ecolab rather than trying to pick a pure-play, unproven AI cooling startup. Pure-play startups often operate with massive cash burns, negative margins, and rely on continuous rounds of external funding.
Right, they dilute you to death. Ecolab avoids that entirely.
The traditional mops, buckets, and water treatment contracts act as an internal bank.
That is exactly how to model it. The foundational, recession-resistant core businesses selling surgical sanitizers to global hospital networks, hygiene solutions to international hotel chains, and compliance protocols to mega dairies generate vast, predictable rivers of free cash flow.
That cash flow is then strategically redirected to fund the explosive, high capex ventures in data center cooling and biopharma resins.
It provides you, the retail investor, with a highly unique structure. You gain direct exposure to the hypergrowth of artificial intelligence infrastructure and advanced life sciences, but it is entirely underpinned by the defensive safety floor of a globally diversified, recession-resistant industrial giant.
Which sets a very strong foundation for how management is viewing the future. Looking at the guidance provided by CEO Christophe Beck and CFO Scott Birkeland for the second half of 2026 and beyond, they are clearly operating with immense confidence in this dual-engine structure.
Oh, they came out swinging with their forward-looking projections. For the second half of 2026, they expect their pricing power to remain highly durable, guiding for 5% to 6% sustained pricing realization.
And they project their organic sales growth will actually accelerate from the current 5% into the 6% to 7% range.
And they expect their adjusted operating income margin to hit 19%.
But for the retail investor, the ultimate headline from the call was the upward revision of their full-year guidance. They officially raised their 2026 EPS expectations. They are now projecting earnings per share to land between $8.05 and $8.25.
That represents a 7% to 10% jump over their previous year's performance.
But they didn't just stop at the end of the current year. They looked further down the road and reiterated their long-term structural algorithmic targets. They are committing to 5% to 7% annual organic sales growth, 12% to 15% annual EPS growth, and they heavily reaffirmed their primary operational goal of hitting a 20% total company operating margin by the year 2027.
That 20% margin target is the holy grail for Ecolab's ongoing corporate transformation.
I want to dig into that 20% target because during the Q&A, an analyst asked a very sharp question regarding the math behind that promise. We just spent a significant portion of this breakdown discussing how aggressively Ecolab is acquiring companies, specifically the massive purchase of Coolighter in the data center space.
Right. When a corporation acquires another company, especially a high-growth tech asset, they typically pay a premium. That premium creates heavy amortization costs that have to be recorded on the balance sheet, which systematically drags down reported operating margins.
Right, it is a non-cash accounting expense, but it penalizes the reported profitability metrics.
So the analyst essentially asked, how can management definitively promise to expand the company's operating margin to 20% by next year while simultaneously swallowing the massive new amortization costs generated by the Coolighter acquisition?
The response from the CFO, Scott Birkeland, revealed a fascinating quirk in their accounting timeline that retail investors might completely miss if they only glance at the headlines. To understand it, we need a brief history lesson. Over a decade ago, in 2011, Ecolab executed a monumental acquisition, buying a massive industrial water treatment company called Nalco.
That was the deal that truly transformed them from a cleaning company into a global water management giant.
Exactly. And for the past 15 years, the heavy amortization costs from that legacy Nalco acquisition have been sitting on Ecolab's balance sheet, quietly weighing down the reported operating margins every single quarter.
Think of amortization in this context like a massive 15-year commercial mortgage on a factory. Every quarter, you have to record that payment, and it reduces your reported profit.
Okay, I follow the mortgage analogy.
What Birkeland pointed out is that the 15-year amortization schedule for the legacy Nalco acquisition officially concludes next year. The old mortgage is finally paid off. The accounting penalty completely falls off their books at the exact same moment that the new amortization penalty from the Coolighter acquisition begins to take effect.
That is incredible timing. The accounting drag from the old tech acquisition vanishes, just as the accounting drag from the new tech acquisition appears.
They perfectly offset each other. The new Coolighter mortgage simply replaces the old Nalco mortgage on the balance sheet. Therefore, the new acquisition will not create a new drag on their current margin run rate.
And when you combine that stable accounting baseline with the structural mix shift we discussed earlier, where the highly profitable global high-tech, life sciences, and digital divisions are projected to constitute 25% of the company's total sales by 2027, the math clicks into place.
A quarter of the entire enterprise will be operating with software-like, high-margin economics.
Precisely. The combination of expiring legacy accounting costs and the aggressive operational pivot toward premium, highly engineered solutions provides management with the mathematical certainty required to reaffirm that 20% margin target for 2027.
So let's pull all of these threads together and bring it home. We have dissected the Q2 2026 earnings call. We've looked at the EPS beats, translated the technical realities of AI liquid cooling and biopharma resins, and explored the accounting mechanics supporting their future guidance.
What is the Talk Ticker's bottom line for the retail investor listening today?
From an operational and strategic standpoint, my view is unequivocally bullish. What this transcript documents is a masterclass in massive corporate execution. You have a legacy industrial enterprise that faced fierce global commodity inflation and proved it possesses the pricing power to pass those costs on to its customers in 90 days rather than 2 years without sacrificing its customer base or market share.
That alone qualifies it as a premium defensive holding in any portfolio. The pricing power proves the moat is real.
But the true value unlocks when you combine that defensive moat with the flawless execution of their strategic pivot. They are actively channeling the cash flow from their recession-resistant core into the absolute highest margin, highest growth sectors of the modern economy.
They aren't just participating in AI infrastructure cooling and biopharma manufacturing. They're actively designing the critical proprietary systems that allow those industries to scale. They have engineered a unique self-funding compounding machine.
That aligns perfectly with my takeaway. The core, actionable mandate for anyone evaluating this stock is that you have to completely update your mental model of what Ecolab actually is. If you still view them as just a slow-growth industrial chemical supplier or a boring dividend aristocrat, you are mispricing the asset.
It is a highly diversified, economically resilient cash machine that has successfully embedded a massive high-velocity call option on the two most capital-intensive trends of the 2020s: artificial intelligence compute and advanced healthcare. It offers the rare combination of robust defensive stability with aggressive, tech-like upside potential.
It is a fundamentally different company today than it was even 3 years ago.
It really is. But before we wrap up this deep dive, I want to leave you with one final thought to mull over as you watch how this specific stock and the broader tech market develops over the next few years. We started this breakdown by joking about how a traditional industrial cleaning company completely shattered our expectations by dominating the AI data center cooling market.
The corporate pivot that nobody saw coming.
But let's extrapolate the physics of that pivot forward. As artificial intelligence models continue to evolve, moving from text-based queries to real-time video generation to full immersive virtual simulations and eventually toward artificial general intelligence, the sheer density of the computational power required is going to multiply exponentially.
The chips will draw more power, and they will generate significantly more heat per square inch.
And simultaneously, as the climate changes and populations shift, local governments across the globe are inevitably going to enact stricter, more punitive environmental regulations regarding industrial water consumption. The collision between the heat of the AI revolution and the scarcity of municipal water is unavoidable.
It is the immovable object meeting the unstoppable force.
Exactly. So here's the question to consider. As that collision point approaches, is it entirely possible that an unglamorous legacy cleaning and water treatment company from Minnesota actually holds the ultimate physical bottleneck key to the entire future of global computing power?
If the advanced silicon cannot be thermally managed without draining the local municipal reservoir, the permitting stops, the data centers don't get built, and the AI revolution physically halts. It truly is that binary.
The company that controls the thermodynamics might just quietly control the entire ecosystem. It's a fascinating reality to watch unfold. Thank you for joining us on this deep dive into Ecolab. Make sure to keep an eye on that upcoming November Supercompute event for their updated high-tech targets, and we'll catch you next time.